This video is on mutual funds. So, what exactly is a mutual fund? A mutual fund is a company that what they do is they have clients or investors who give them money, and then that mutual fund takes all the different money from all its different clients, puts them together, and uses that pool of money to buy investments that they think will earn a higher return than average. And it might be that they invest in stocks, bonds, international, real estate. And for this service, they charge you a fee. There are many different types of mutual funds. You can categorize mutual funds based on the type of thing that they're buying, the type of investments that they buy with that pool of money. Maybe they buy stocks or bonds, or they have a balanced approach. Balanced approach just means a combination of these stocks and bonds. You have real estate, mutual funds. You have mutual funds that specialize in physical assets or physical things that they invest in, whether it is a uh, like gold or silver or metal, or maybe they invest in physical buildings, real estate. And the final one is a money market mutual fund. I feel like this is not used as common uh, with people. Most mutual funds sit right here. All right. And there are some mutual funds that exist where they will actually charge you a lower fee if you put in a certain amount of money. If you at least invest X amount of money with them, they will actually charge you a lower fee. All right. You also have mutual funds based on the section of the economy that they're investing in. Here are some common types. You have mutual funds that invest in technology, mutual funds that invest in energy. This might be either a coal company or an oil company or a renewable energy company. You have real estate mutual funds, you have healthcare mutual funds. So there are mutual funds definitely that specialize in each different type of sector or different part of the economy. You have mutual funds that invest uh, and specialize in different areas. So there are mutual funds that are country specific, like a mutual fund that exclusively invest in China, or there are plenty that exclusively just try to invest in the US. You have mutual funds that invest in a area in the world, uh, so that will encompass more than one country. For example, you might have a mutual fund that invests in Europe or in Asia. And bigger than that, you have mutual funds that say that they invest in developed countries. These tend to be the rich countries. And you have mutual funds that specialize in investing in developing countries. So if you aren't part of this group of developed countries, then you fall into this group of developing countries. And then you have some mutual funds that say they invest a little bit over the whole world. You also have mutual funds that uh, the way that they specialize, they say that they are a stock mutual fund, so they invest in stocks, but then they target a specific section of the stock market. They might say that they target a specific size company, large, medium, small, or they might target a specific type of strategy that companies might use. So they're looking for companies that are high growth companies. Maybe they say that they are a mutual fund that invest in companies that are a good value at their current price. You have income strategies, you have dividend strategies, and there's a good amount of overlap between these two. And in addition to companies that focus on stocks, you have mutual funds that focus on bonds, the other major category of mutual funds. And different bond and mutual funds might focus on different types of bonds. Some of the most common are right here. They might have a mutual fund that exclusively focuses on municipal bonds. These are bonds sold by a city or state. You have mutual funds that exclusively invest in corporate bonds. Corporate means like companies or the debt that companies sell. You have inflation protected bonds. You have asset backed bonds. Inflation protected bonds are bonds where if inflation goes up, the bonds that they bought increase in value. You have asset backed bonds and mutual funds that focus on that. This word asset is talking about a physical asset. So if you have a mortgage backed bond, that is a bond where the money that the bond is getting comes from people's when people are paying their mortgage. You have mutual funds, bond mutual funds that focus on area, just like for stock markets. So you might have an international bond mutual fund or a domestic bond mutual fund. International being outside the U.S., domestic meaning inside the U.S. You have bond mutual funds that focus on different grades of the bonds. So maybe investment grade, or the opposite of that would be the high yield or junk bonds. You have different bond mutual funds that focus on different lengths of bonds, whether they're buying bonds that are really have very long maturities, like 10 years, 30 years, or something that's really short, 3 months. So there are many, many different types of mutual funds that all focus on different things. One specific type of mutual fund that I do want to talk about that is different from the rest of these is your target date fund. This is a newer sort of financial thing they invented. A target date fund is a mutual fund, and it's designed as a one-stop shop, sort of. It is designed as a buy this one fund, and I'll take care of all your investing for retirement needs. So the way that the bond does this is that the bond will rebalance the funds as the investors get older. What do I mean by that? So in terms of how much of your investments you should have in stocks compared to how much of your investments you should have in bonds, in general, as you get older, you should have less and less stocks and more bonds, because that is a safer strategy. So this target date fund, what it does is, as its group of investors are getting closer and closer to retirement, that mutual fund will automatically move some of the money from stocks towards bonds. That way, it more matches what that aged investor should own. An example, if you see a bond fund called this Target Retirement 2065, this is a target date fund. That's what target means. This is a target date fund for people who are expecting to retire in 2065. So this might be someone who right now is 20 years old, and in 45 years, they're saying they're going to retire. So as we get closer and closer to the year 2065, the target date fund will automatically shift more and more of the stocks into bonds. Even by the time this person retires, there will still be some stocks in there. There will just be fewer uh, than it started with. So those are all the different types of mutual funds there are out there, and there are a lot of them. So what are the benefits? Why would anybody give a mutual fund their money to invest? So let's compare mutual funds, and let's compare it to you buying individual stocks. So a mutual fund, one of the biggest benefits is its diversification. What does this mean? If you buy individual stocks, let's say you go and you split your money between 3 different stocks, and one of those stocks does poorly, your return goes down by a lot because that one stock is 1/3 of all your investments. Now, a mutual fund pulls the money from a lot of different people so that they can buy a bigger group of stocks or bonds. But since they have a bigger pool of money to split, they can buy a lot more different stocks, so that if one of them does poorly, it doesn't drag down the whole investment portfolio that much. So with a well-diversified portfolio, a well-diversified stuff that you own, there will be less volatility or less ups and downs in the performance of that investment. And this is generally considered a good thing. The second benefit for mutual funds is that someone else is doing the work. We all have other things in our life that we have to focus on. So by paying someone to do this, you don't have to. Mutual funds are also one way of investing in some of these assets that are normally not very liquid. And because you're investing in it through a mutual fund, it is much more liquid. And once again, this word liquid or liquidity talks about how easy or difficult it is to change that thing you have into cash. Now, normally when you buy real estate, in order to turn that real estate, in order to turn that property into cash, you have to go through a month-long process. And you have to pay anywhere from 5 to 10 to 15% of the value of that property in fees to somebody. Now, if you invest in a mutual fund, if you give a mutual fund your money and they go and buy real estate, and then you need your money back, you can just sell shares of this mutual fund to somebody else pretty easily. So therefore, much more liquid than if you bought these individually yourself. So those are the benefits to using a mutual fund. If you're paying someone else, though, to do this work for you, they're going to charge you something. So these are the fees that are common for mutual funds. This here on the left, every mutual fund charges an expense ratio. This is what percent of the money that you have invested with them do they take as a fee per year. So for example, if you have a 1% expense ratio and you gave them $500 to invest, then every year they charge you 1% of that $500, or they charge you $5. And that $5 just comes straight out of your account, goes in to pay for the professionals that are doing the work. So the average expense ratio uh, is right now around 0.5% to 1%, and it's higher or lower for different mutual funds, mainly depending on what type of mutual funds. Are they investing in large companies or small companies? Are they investing in growth, dividend? Are they investing in the US or someplace else? So, depending on what type of mutual fund it is, this expense ratio can be very different. The harder it is to find information for that area that they are focusing on or specializing on, the higher the fee they generally will charge, because they have to do more work to say find out uh, information about a developing country than a developed country usually. Or if they have to go and research 500 small companies, that's going to take more work than researching 5 large companies. So, in general, the harder it is to find information, or the more specialized the mutual fund is, usually the higher the fee they'll charge. An example of a very low fee is a company that invests in large companies here in the US. It is very easy to find information about large companies here in the US. So, therefore, a mutual fund that specializes in that does not have to put in as much work, and so therefore does not have to charge you as much of a fee. Here on the right are fees that are sometimes charged, but not always. It is, in fact, quite easy to never pay one of these fees. But some mutual funds charge it, uh, something called a front end load, which is basically when you first put money in, they charge you a percent of that. And I read that it is typically between 3.75% and 5.75%. There are also mutual funds that charge the opposite of that, which is a back end load, which is when you take the money out, they charge you a percent. For some people, they would argue that having one of these fees isn't that big of a deal. Uh, Most companies that charge you one of these fees will charge you a lower expense ratio. I personally avoid these, but that doesn't necessarily mean that it is always a bad deal. So there you go. That is generally what a mutual fund is. A mutual fund focuses on different types of investments, and they can get very specialized in sectors, regions, and in exchange, they charge you a fee. The benefits is by pooling everybody's different um, money together, you're able to diversify better.